when we talk about things like 2025, are we going to get there? I think it's worthwhile to just try to do this exercise historically and say, in 2013, what did you think the GDP in 2019 was going to be? And I think that nobody could have predicted and have gone through the kind of, that India would have gone through the kind of short-run turmoil that we've seen, and really had a sense of what a 6-year or 7-year projection could be, right? So I think long-term projections are always fraught and contingent. I don't want to, it's not a way of escaping from the question, but it's really to say that what we ought to be concerned with are the current issues, some of which are legacy issues, and also to be thinking about all the other kind of things which really will help with our, maybe the more important indicators in the end for our welfare. Of course, every journey of 1,000 miles begins with the first step, etc. I'm also reminded, of course, of the famous quote that precedes Keynes's long-run quote, which is that economists give themselves too easy a task if they say in the long run everything is all right. In the long run, we're all dead. What we really have to look at is the short run and what's happening right now. And I think it's important to be aware of the full force of the current conditions that are facing us. These are just 3 of the many horror pictures that people have been sharing. This is percentage changes in change in income, expenses, and profits for all non-financial listed corporates. The CMI data, quarterly GDP growth rates of housing finance companies, because that's of course where the nerve center of the latest crisis has been. We've seen all of these things together, and my sense is that we have to look back and see the proximate causes were really a legacy issue and an undealt with legacy issue. We had over-leverage, balance sheet overhang. Currently, we have a sharp demand slowdown. We can see that with electricity generation. We see that with investment overcapacity. There are long-term issues. I think it's important to say that not everything is cyclical. There are probably some long-term issues. For me, my primary concern is what are the sources of what I might call transformative demand. Most economies which have transitioned from being low to medium to high income economies have gone through a period where exports in some sense give them technological, push them towards the technological frontier, and certainly in some sectors we're able to do that, but we haven't done that in a broad-based way in which other economies have managed. There is the question of the dual economy. There is the question of the fact that our capital productivity is lower than it would ideally be. And the question of, finally, whether a reliance on consumption and investment versus something like exports, which is more typical of a successful transition, is something that we should be concerned about. Obviously, these are technocratic questions, right? Sorry. Okay, so the recipe, why are we here? I think it's pretty clear. We had legacy problems. Over-leverage, which is itself the result of 2 things. One thing I think the Urban Modi Committee has made very clear is debt has been treated favorably relative to equity. And we've had, before the IBC and even with the IBC, bankruptcy resolution frameworks have been inadequate to deal with what we have to deal with. On the supply side, we've had weak credit assessment and this complicated political economy of banks. We've had that. We shouldn't shy away from the fact that in many ways the banking system have been used to was really suborned to the political impulses, right? The twin balance sheet crisis. And the next slide is, I'm going to sort of heartily echo Abhishek. I feel like inflation targeting has been, at least the way that it's been implemented, has been one of the big problems of our economy in the last 5-6 years. I think particularly in the context of a balance sheet overhang, low inflation is a big problem. Yeah. Because one of the things that balance sheet recessions, and here I'm echoing something that Richard Koo has been speaking about for the last, from Nomura Securities have been speaking about for the last 20 years almost, is that when you have low inflation, you're going to have difficulty with paying back, and repairing balance sheets becomes even harder. And typically for him, you also need fiscal policy to be involved. Sorry. So on the demand side, I would say that we've had 2 shocks. You take this this framework. On the demand side, you have 2 shocks. You have demonetization. You have something GST. You know, I don't have too much to say about that. And I think inflation targeting really should be seen as a demand shock. It really has been something that has been continually dampening demand, the ability of firms to actually expand. Right? What is the result? There's risk aversion in non-financial firms. That results in a collapse of investment, deleveraging, hoarding of excessive liquidity, anticipating liquidity stress. You can see these in the indicators. And the financial sector, the same. You have a risk aversion, and so a lack of adequate credit creation. All right. So this is the recipe for what's happened. Now, in the near term, I think the prospect of some sort of organic recovery is bleak. And the reason is that obviously, whenever you have balance sheet issues, I've not known of any situations without some very clear financial policy, some sort of bad bank, some sort of QE, all of these kind of things. It's very rare that you actually see a sort of organic recovery. So I think you do need some sort of financial policy on this. And there are also these other smaller solutions. Rationalization of GST would help. This is an open question. I mean, I'm a little concerned. Is it possible that you'll have a stock market correction? Right now, inflows don't seem to suggest that, but maybe that might happen. The NBFC crisis is far from resolved, and it doesn't seem that we have a policy for that. So until that's resolved, I'm a little nervous about these things. So I think you'd need that, and you need monetary and fiscal policy. I'll say a few words about the latter two, and then I'll stop. So with respect to monetary policy, I think our monetary transmission policy in general has been weak, and we've had too much of what you might call a cult of the central banker. I remember when Dr. Reddy used to be widely attacked and condemned, and then we got into this era of the central banker being this colossus figure. So I think that has been a bit of a problem. Inflation targeting has meant that real interest rates have been damaging. I'm not clear that when we should sort of give necessary credit, if you want to call it that, for disinflation coming from the demand side. I think it really has been a supply side effect just as much. And of course, the big problem is low inflation can wreak havoc on leveraged balance sheets. For the government expansion, which everyone is talking about, it's essential that you have the growth rate of GDP actually be larger than the interest rate. That allows for fiscal space. In fact, with large debt stock, that is the primary way that you're going to make a fiscal space. The idea that inflation targeting is a way that you actually stabilize expectations, I'm not so sure. I think expectations, more and more evidence is that it's adaptive. And so I think there's a case for a substantial reduction in interest rates, and just echoing what Abhishek has to say. Here's where I think I'd say something which most people possibly in this room may not agree with, which is that I think monetary policy is unlikely to be sufficient. Demand shortfalls in the economy, which I think are real, means that even if you unclog credit, to an extent it might be pushing on a string. You still should do it, but I think it's important to my own feeling is that it's inadequate to just have monetary policy do everything. My sense is that fiscal expansion, if correctly targeted, is likely to crowd in the sense of crowding in other private investment, but it does require you to have a compliant monetary policy. I'd like to see not just things like corporate tax cuts, but actually clear expenditure, and that really is important. And devolve expenditure. Sometimes you have statements like we don't have shovel-ready projects, and that's true, but devolve expenditure if necessary to the states which can do this. Very simple things that we ought to do right now: pay bills on time. Exploit our unused cesses. We have this large education cess that's sitting there. Just use it right now. I also think we have to have a better understanding of what actually a fiscal deficit is, and before we start worrying about it, if it's mainly interest payments, what we really should be asking for is greater primary deficits. Actually, if the interest rate falls, our interest payments will also fall. Fiscal deficits the primary deficit can go large, and we do need bigger primary deficits. In the medium term, inflation, people are worried about stagflation. Suppose I expand. My own take about this is 5 to 8% inflation, if it can be managed at that range, which is above, I'm talking about something clearly above the mandate, is likely to actually be helpful. I don't see this as something that's going to create some sort of hyperinflationary spiral. We never have that kind of situation here, especially given that inflation is supply driven, and it can be a way to repair balance sheets. Last slide. I hope I haven't taken too much time. These are longer term questions, and these are more speculative. I sort of disagreed a little bit with the previous speaker, in which the idea of affordability was sort of dismissed. I do think that we have far too narrow an economy and economic base. We really ought to have a situation for the vast majority where food, health, and education is high quality and less expensive. That has been really kind of the central kind of social policies that were there for the economies which did transition. It can also help to have better, if you have much more productive labor with this whole question of technological unemployment. I'm not as much of a votary of saying export processing zones, but I completely agree with Dr. Virmani that we have to have industrial policy with respect to global value chains. And then finally, there's the question of the sociology. I think this is something that I find very puzzling, which is why is it the case that we do have such inefficient organizations in general? And that's something that we have to deal with in the medium to long term. To end with, I want to just suggest that about 2-3 years ago, everyone was confident that until 2023, 2025, we would have 11, 13% nominal growth rates. I don't see anything that's fundamentally changed in that. I don't think that there's been any. The only thing that's been changed are these demand side effects, and I think those have to be resolved. But I don't think that in some sense our potential growth has changed substantially. So I'll leave it to that. Thanks.